Hi everyone. If you can hear me, can you just drop it in the chat? I'm all alone recording from home today. I'll explain more of that in just a minute. I can see everyone's got started without me and having a bit of fun here by the dip, says Alex. That sounds fun. I like the idea of that. If you can hear me, please let me know. We actually may be joined by a special guest today around 12:20, 12:30. So a lot of last minute preparations for today's live show, because some of you will know that usually when we talk about investing, it's usually on the positive, the affirmative front. I do the live shows. Thanks, Crampo. I do the live shows. Well, I did the live shows for almost 5 years. And it's only in the last couple of months that we stopped the weekly live shows and focused on our podcasts and whatever. And so usually they're more optimistic, upbeat, and these types of things. Today, we're going to be talking about the market crash or market sell-off. I don't really like the word crash too much. You'll see on the thumbnail of the video, it says crunch. Good to see you all here. Got so many questions. And what we're going to do is we're going to run through. G'day, Percy. Everyone, thank you for doing that, Ron. We're going to run through some slides, then answer questions. We're going to talk openly about certain things. And of course, we will have a bit of a disclaimer in here, which I know is everyone's favorite thing in the world. Like, my stock brokerage account has just crashed. What's going on with Navexa? I can't get in. The websites are all going down. But hear me out. We need the disclaimer first. So let's get on with that. So slides, here we are. Okay, so a bit of a market sell-off. We're going to do that today. Today we're going to cover the ASX market sell-off, what it means to all of us. We're going to ask ourselves, is this unusual? Why are investors reacting so badly to tariffs? It's not so much a 5-part personal finance checklist, but I'll introduce you to that, as well as a 5-part investing checklist. And we'll have something for ETF investors and individual stock investors. I'm just going to bring this up a bit here because it looks a bit small off to the side. But basically, we'll bring that right to the front like that. You can see I just did a quick Google, no shade on any of these particular news outlets. But obviously, if you just Googled ASX 200, stock market, whatever today, it's not going to be pretty. So yeah, if you go to many of the most popular websites in Australia for finance, you'll see things like this up here. You'll see things like, we're experiencing unprecedented levels of traffic. If we've got, I think I had ComSec, no, not the community. I think I had ComSec up before. ComSec was saying the same thing. I don't need to bore you to death with that. There's talk in our community, in the Rask community, that some brokerage platforms have actually gone down already. So as in, like, the whole thing has gone down. So there are some things here which are showing not very good things for a lot of people. Looks like Tim was on a phone call at the time of him checking the BetaShares app. That's okay. These things happen. Hopefully it was a good phone call, Tim. Okay, so let's move on. If you haven't already subscribed to Rask on YouTube or whatever, that's totally fine, but we do these things when you need us most. So you may as well subscribe to YouTube, Facebook, wherever you're watching. We've got a bunch of different shows every week, some of the best podcasts in Australia. General financial advice warning. So anything that I do say today is limited to general financial advice only. I don't know your needs, goals, or objectives. So meaning that I don't know what your risk profile is, your financial situation, all that sort of stuff. Even if you tell me in the chat something about yourself, I need to make sure. You can hear my shirt. Is it rubbing against that? Is it? I'll turn that off 1 second. And 1 second, I'm just going to get a coffee. So I didn't have a chance to get my coffee this morning from the shop. So my lovely wife just did that. So thank you to Sarah there. So general financial advice warning, don't need any needs, goals, or objectives. If I talk about ETFs, managed funds, brokerage accounts, all those different types of things, obviously go and read the product disclosure statement, TMDs, and terms and conditions and all that stuff. You can read the Rask Group's financial services guide at rask.com.au/FSG. Okay, so enough of the legal stuff that we've got to do. Let's get into it. So you can see here, this is basically a rundown of global markets. I'll blow them up a bit for you. Here, you can see on global markets, this is the Australian market, I should say, actually, approximately 20% of the years that you invest will be bad. And sometimes very, very bad. Like here, I know we've only got a certain amount of pixelation on the computer screens and phones that you're running, but in 2008, the stock market fell, I think it was 44% or something in 1 year. There was another year around that, which was pretty bad. So there were multiple years in a really quick patch that were pretty negative. But then on the affirmative side, you can see that the majority of years are positive. You can see 2009. The sound is harder to hear now. I'm just going to switch it up again then. I just want to make sure that my shirt's not crunching too much. Sorry, guys. So we'll see if that works better for you now, Nicole. Please let me know. As you can see, it's the last minute operations today. Normally we would have a bit more polish than this. So we can see here that the market was positive, really, 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 really positive. I'll bring out my Mr. Squiggle just here on the canvas screen. So we'll go like this. You can see, get rid of that, make it more like this, make it more like this. You can see here there was a really, really positive year right after a really, really negative year. So people who often sell out at the worst possible time then have a double whammy, because on the other side, they lose twice because they've lost 40% here. And then on the other side, they've missed out on, let's say, 35%. So they're actually in effect, a double loser. And so one of the worst things people can do is sell out of panic. There are good reasons to sell. Of course, there are good reasons to sell. Like, wouldn't it have been good to sell in 2007? But the reality is, selling out of fear is never a good idea. Unless, of course, you're completely in the wrong investments in the first place, then maybe you have a reason to be fearful. But one of the things that people often miss about stock market crashes is that even though, yes, negative years are normal, the key thing is that the year leading up to a market crash like this, the year before that can actually be very positive. So if you've predicted something, right, like let's say you predict that the stock market's going to crash, and you're right. You're one of those very few people in the world, like the Big Short. You're right. The market does crash, right? The problem is the year that you predicted to fall, it might not fall straight away, and it may actually go up in the time that you're still predicting it to go down. And that's why Peter Lynch, the famous investor and the author of One Up on Wall Street, said he's convinced that more money has been lost waiting for a market crash than in one. And so that's really important to understand. Angie, will this be available after 12? It will be, Angie. It's available on playback. So that's the Australian market. You can see over 125 years, thanks to market index data, the stock market, even though negative years have eventuated, it's actually on average up 13%. On average. And this is, keep in mind, everyone, if you're watching this, this is when the Great Depression happened. This was during the Cold War. This was during the Middle East War. This was during the First World War, the Second World War. The stock market, on average, went up. Not every year, that's obvious here, but it went up, okay? So keep that in mind when we talk about tariffs, is that not, this is a self-induced sell-off. We've got, effectively, the American president and his administration putting on tariffs, which is causing the market to fall. It's not like the global financial crisis, at least not yet, which was this one here, which was virtually that was unpredictable. If it wasn't for the central bank governor of the United States, Ben Bernanke, and printing money to try and help the economy, just giving people lots and lots of money, that could have been way, way worse than what we've seen here. Okay, so the other one here, so that's the Australian market. Let's look at the US market. Remarkably, this data comes from curvo.eu. Remarkably, it's almost exactly the same in the numbers. So if you look at a market crash, right, we take the stock market as a whole, we get the best years, the worst years. You can see this chart here, right? More green than red. One big red here, which was the worst crash ever recorded, which was the global financial crisis. If we come down though, where is it here? So we can see between 1993 and 2024, the US stock market rose 81% of the time. That means it fell 19%, or 1 in 5 if you're up with your maths. So exactly the same cadence as the Australian one. So if you're watching this and you're thinking, I'm panicked, it's fair enough that you would be panicked. But if this is your first time experiencing one of these, you should know that this is not my opinion. This is just the data. What it's telling us is that 1 in 5 years will be bad. That's it, right? 1 in 5 years. It's not me making stuff up. It's not me trying to sell you something. It literally says 1 in 5 years are bad. Now, oftentimes there's another belief in stock markets. I haven't done this math myself, but there's a belief that 1 in 5 years the stock market goes back, and 1 in 5 of those years when it goes back, it's really back. So like this year right here. So you can have just normal market falls like the red ones here, these ones, but really one of those is going to be really bad. Now we could be at one of those moments, but we might not be, because as you can see here, straight after the GFC, the market rebounded. Straight after COVID, the market rebounded. So what are we to do? Do we sell? Maybe we're right. On average, we would be right to stay invested. On average, we would be right to stay invested. I don't know what's going to happen in the next year. No one does. Not even those people that are currently writing those headlines, especially those people, to be honest, they have no idea. What's really important to remember is why you invested, and to remember that you stay invested. Now let's get on with some of that sort of stuff. Now I'm going to start with stocks. Most of you know that I'm a chief investment officer at Rask. I don't spend most of my time looking at individual stocks these days like I used to. I still teach the value investor program, but I don't, this is not the core of my portfolio. You can view the core of my portfolios by going to the Rask website and just going to /Rask Invest, and you can see them all. And this is the thing, you don't even need to pay us. You can just look at what's in our portfolios. We don't hide it. So it looks like the Navexus site may be experiencing a bit of a glitch right now, a bit of a glitch in the matrix. But you can actually see what we hold. So some of you will have seen my email the other day, on yesterday actually, it was when it went out. I invested another $100,000 last week. Where am I? This is the wrong one. Here we go. I invested another $100,000 last week, and I invested it in this strategy here, which is the Terra strategy. And the only difference in this one is that it's 50-50. So I'll explain what that means in a minute. It's 50% shares and 50% defensive. 50% growth, 50% defensive. Just remember that, 50-50. And I'll explain why. But those portfolios, as you can see, are all ETFs. We can do anything. We can do stocks, we can do managed funds, but they're all ETFs. Here's the actual current breakdown. Maybe we'll start with the ETFs and then move outwards through a core and a satellite approach. For those of you that don't know what a core and a satellite approach is, typically at Rask, what we advocate for all of our clients and investors to do is to have a core portfolio like this one, which is low cost, easy to manage, tax effective, all that stuff, right? But then around the outside, you could have like little satellites. So imagine that these are like stocks or whatever that go around the outside. And while the middle might be 80% of your, that looks, you can't see that. While the middle may be 80% of your wealth, you could have these little satellites around the outside, which might be 20%. Now, if you have a lot of money in super or something like that, consider that part of your core, not your satellite. Like you don't necessarily want to buy, if you're not really, really in tune with investing, you're going to meet an investor in a minute who is really, really in tune with investing. If you're not really, really in tune with investing, keep it simple or get financial advice. That's what I would say all the time. Don't necessarily go with a lot of stuff you don't understand, especially if you're in retirement. Okay, so ETF investors, do you feel comfortable with what you own? Why did you buy the thing in the first place? If you do know like why you own a particular ETF, one of the best things you can do right now in this moment when you're fearful is write down what it does and why you own it. So if we just take that ETF as an example, and we go to, say, the BlackRock website, which is where this ETF comes from. Let's have a sip of my coffee. So we can see that this ETF is down 6% in a day, which is pretty scary. And we see over 5 years, we see how it's grown. It's grown remarkably well, like 11% per annum, even though it's fallen 6%. Incredible. This is great. Really, really great. Obviously, full disclosure, sorry guys, I'm drinking this coffee. I own this ETF. I should have said that to begin with, but You get the point. So go in, have a look at like, what is it doing? Well, it's investing in all these different sectors. It's got different companies inside it. You can actually go and click underlying holdings here. Different investments inside it. You got some Microsoft, you got some Facebook, Amazon, Berkshire, which is Buffett's company, Tesla, all different companies, right? That's an ETF. You can do that for all of the ETFs in your portfolio. And if you like it, that's great. Wonderful. Just write it down and you'll be okay. Next is, this is probably shouldn't be number 3. It's just, do you need financial advice? If you haven't got financial advice and you're feeling worried, maybe now's the time to start thinking about it. It does take a month or 2 at least to get financial advice in Australia. So keep that in mind. The costs vary from like at the lowest possible end. I wrote about this the other day. Maybe I should put that in the chat. How much does a financial advisor cost? Because some people say they Google this and they get some AI. Why did it come up with that? They get some AI response and it's not actually correct. So let me just pop this down here. I'm going to pop it in the chat now. There's the financial planning thing. So this article would explain to you what financial planning actually costs and how much it's worth. But typically you're looking at 4,000 up to like 15,000, to be honest. So this is really, really important. Dean, you said, Owen, it's so good of you to be doing this right now, considering your day job. You're a beast. Thanks. Well, Dean, you know, one of the things is, I really appreciate that sentiment, my friend, but one of the things is, mate, that we have, 200,000 plus people in the Rask community. So it's much easier for us to do it this way and to communicate our thoughts and our ideas with people than to sit down one-on-one. So it does help that we can get out here and do this as same said for the investor that's just about to join us. Do you need financial advice? Get it if you're unsure. Asset allocation, you can see here. So asset allocation is just a fancy way of saying how much growth versus defensive. And we can see here, growth would be, an example of growth would be these things, this half, and defensive would be this half. So this is a 50-50 portfolio. That's what we call it. 50-50 portfolio is right there. You can see that. So Nicholas, are financial advisors really worth it these days, given people such as yourself providing general advice? Well, Nicholas, I didn't always think so, but now I've realized how vitally important it is to get financial advice, because most people who think they can DIY their finances find out that they shouldn't do it when the market falls. And secondly, the people who are most confident in their personal finances are probably the ones who could get the most benefit from working with an advisor, because it's kind of like a coach. So that's the way we think about it. So I think it's definitely worth it. Like, one bad mistake in a market crash is going to cost you way more than $4,000 if you're investing in retirement portfolio, like hundreds of thousands, if not millions. So definitely worth it, in my opinion, especially at retirement anyway. Are you due to rebalance? So a quick way to figure out if you should have, like, if you've set it up correctly, so say you've got your strategy set up, one way to quickly figure out if you should rebalance is, has this part of my portfolio grown so much that the other part of the portfolio shrunk? So like if it was 60-40, if the stocks fell and the other part of the portfolio was therefore a bigger percentage, that might be a good sign to rebalance. We rebalance at 10%. Would your future self remember this moment in this market crash? What does the data say? So one of the things, if in doubt, zoom out. One of the things you will see that we started with was zoom out to get a better perspective on your overall plan and make sure that you understand, is this normal? Because if you do understand that this is normal, well, maybe it makes things a bit better. I'm going to leave this one for the gentleman that's about to join us in just a moment. So staying invested is always much harder than getting invested. You can invest $5 nowadays in Australia if you really want to. Staying invested is the hard thing. Getting invested is the easy thing. Staying invested in a market crash, I've always found to be harder, not just for us, but for our community. I think that that's the most important thing, is just remembering how hard it is. So final thing here on staying invested, make sure you've got a strong cash buffer before you put money to work. We're going to talk with Claude Walker in just a moment. I can see that he's online now. Maintain a strong cash buffer. Remember, if you're worried about your portfolio, speak with other people. Don't act on what they tell you necessarily, but just speak with them. Get it off your head. Like, it's a really proven strategy to talk about investing with other people. Like, smart people will help you make better decisions. Maintain perspective, learn from others, and remember, even at the worst possible times, the stock market will still be open. So would someone who wants to, sell now, would they be better off buying? I think that this too shall pass. Now, I am going to stop ranting for a moment. I'm going to come back to the stock thing in a little bit, but I really want to bring in Claude Walker, my friend and founder of A Rich Life. Claude, I think we've got you, my friend.
Yeah, great. Thanks. I was listening to you actually that whole time, and it's really good to have somebody preaching the stay calm message when you really have that like thick panic in the air. There's been a build up over the weekend. A friend of mine, who's definitely someone who's been doing this a while, had made the point that you get the most epic panic days on a Monday when people have had the whole weekend to like stew over the news. And I really think that we're like seeing that, we're feeling that today, with just like the epic falls, massive negativity. Like, don't get me wrong. I guess for people who don't know who I am and where I'm coming from, basically just 1 month ago, I wrote out to my supporters of my website, and it was a free to read article, by the way. It's literally called your wake up call. Okay, so like this is essential reading for you to understand where I'm coming from in any way, shape, or form. Because what I basically explained in that is it's that kind of like, if you're going to panic early vibe. So essentially, I have this theory about what Trump and his friends are doing. And what they are doing, in my opinion, is essentially deliberately, I don't even know if it's in the front page. It was like a month ago that I wrote it now.
Okay.
But if you Google wake up call, and A Rich Life and Claude, you should find it. Yeah, there it is. It's got the Mad magazine thing on it. The macronym, that's the one.
Okay.
Yeah. So that's basically I was saying in that. Look, I have a theory, which is that Trump and the others are going to put in these tariffs, which will massively deck the markets, which is now what we're seeing, right? Mm-hmm. And that will do is they're trying to get this bad, painful area out now at the beginning of the term. So those charts would look much different now because it's continued to go down really hard, right? This was at the beginning of March I wrote this. So back then, that was the time to panic and do your selling. And what I did is I sold my. I'm like you, mate, a long-term investor. So I'm not going to go and sell my like high quality, long-term buy and hold forever kind of investments based on this situation. But what I did do is sell a ton of stuff that's non-core to my investing philosophy and my investing approach, and cashed up. And I even put shorts on, which to be fair, I like mostly closed out those shorts before today. So didn't exactly nail that. But yeah, look, the general point is that I put a more bearish stance on. I bought a bunch of gold. Gold's useless. You can't, make anything with gold. But that's how paranoid I was feeling. I was like buying all these like gold ETFs and stuff like that. So that was the time to do it. Now, hopefully you've got the cash on the side, you've got the gold, you can liquidate or whatever other sort of non-productive asset that was just a store of value. And which is cash, by the way. Cash is fine for that because inflation only gets it slowly. And so now I'm actually, today, I already this morning started buying some of those high quality businesses that I already own shares in, which like my core, which and that's why I can't actually say the names of companies that I've like been actively buying today. So, I won't be able to just field a whole bunch of company specific questions today. But if I find a question about a company that I know that I can talk about for whatever reason, because I'm like not active in it, then I would definitely be happy to do that. But yeah, that's where I'm coming from. Like, this is panic day. So my number one message is like, don't actually panic on panic day. Like, look, things could get worse from here. I'm not saying it's the bottom. I'm not calling the bottom, but I'm saying you need to not be panicking on this day. Today's the day to be calm. Today's the day to be, take a breath, go outside, have a laugh. We're all suffering. This is the fetal position day, basically. You can do fetal position, just don't panic, Because I think you're alluding to in your discussion earlier, it's like you could get something. It could be bad if you like sold everything today. Look, I don't know. It could be good. It could be bad. But like that is fundamentally not your strategy, right? If you're a long-term investor, like freaking out and selling everything on a day is not your strategy. That is not what you like signed up for. Now is definitely the time to think about what your long-term strategy is. Take a step out, long-term view. Look, yeah, you could slightly reduce your exposure, or you should slightly increase your exposure. Like me, I'm going to be like nibbling. I'm going to be getting more long today.
Claude, can I ask you?
Mm.
So I know you can't talk about some of the companies for a few like trading reasons and whatever.
Yeah.
But can you tell me? I've got two questions for you. One is, how does this feel to you? Just like, how are you feeling about this versus, say, any of the other market crashes that have gone before?
Well, I actually feel very similar right now as I do in the past market crashes that we've been through. And I also feel very similar to probably, the feeling is also if as I recommend it. So sometimes in the past, probably is going to happen again in the future. I've recommended a company and then maybe like a short time after they've recommended it, there's some terrible news has come and the share price is down like 25%. I'm like, I just told all of the people who I, in a professional sense, love the most to buy this stock. And then now they're minus 25% on it. And then even what if it's actually for bad news and I have no idea? Is it too low now? Like, what should I do? Like, I should have sold it, I wish I just sold it a week ago. Like, I was thinking maybe I was wrong. Like, I was thinking I should do that. Like, I didn't, just all of these thoughts in your head that, those people who are more experienced in like meditation and all that kind of stuff, they probably have the word and the language to describe this kind of like unhelpful self-narrative that can come into your mind. And that's real. Like that's, I think, across the board. I mean, surely everyone's having similar thoughts. Like, I knew Trump was a psychopath. Like, why did I sell my shares? Like, should have got more gold. Why only buy this much gold? Oh, look, my gold's up. It's a tiny position. Like, it's all of these things that, but probably you have your own one. Tell me what you're thinking, but anyone on the call. But yeah, so that is that feeling, and that feeling when that's shouting and everyone's having that at the time, like sociological framework says, at some point this will all be too extreme. I don't know when that point is, but we just know we are a herd animal. This is it. You are seeing the herding right now. Yes. And so we're running. If you're selling now, you are running in the herd. And if you're buying now, maybe you're running against the herd. And if you're just buying a little bit, nibbling a little bit, maybe you're still running with the herd a little bit. You're starting to sort of slow down and stop. That's where I might. Once I feel in the herd, I have trained myself to be like, running with the herd like this we're about to make a mistake. Okay, because overall, yeah, most of the way you make money on the stock market is zero-sum game. Now I have no idea. It could be pain. We could be into 6 months of pain. The long-term pains are worse for me and my business, right? Because when we have a big, long bear market in small cap stocks, which is like my main thing, obviously, like now my portfolio is probably mostly larger cap stocks. But when I started doing my strategy, they were small cap stocks. It's just that they get bigger. So now you might think of me more as a growth investor. But, I guess the one I can talk about because I'm willing to like not trade it today is Pro Medicus, right? So that longer was, I already got overtaken as my biggest position after the last results, which I wrote about on the website. But you can imagine the impact on my portfolio when what was my second biggest position has come down from literally like basically $300 not that long ago to what are we even looking at right now? 176. That's almost, we're like headed for a 50% drawdown here, right? So I reckon we'll probably get there. I would be surprised if we don't have a full 50% smack from the top. So you can imagine when I'm clicking my portfolio, like right now, the market's down 4%. My portfolio is down 5.6%.
Yeah, right.
Like, and that's even after I bought the gold,
So, Claude, if someone was watching this, as potentially 800 people are watching live, and myself, right? And so say we've got like however you invest, whether you got ETFs and shares, no ETFs, managed funds, property, whatever. Let's focus on just shares for a moment, right?
Yeah.
What would be, like, I remember chatting with you and Andrew during the COVID crash, Andrew Page from Strawman.
Yeah.
And the three of us were talking about, like, let's go back to basics. What are the things that you're looking for in a company at this time? Obviously, you've done a lot of research for a Rich Life supporters and for your own portfolio. But if someone's listening to this and they're thinking, what's a good checklist to use in this moment? What would you advocate for? Just simple things.
All right, that's a brilliant question. So the first thing you're going to want to prioritize if you took the Claude Walker approach is management quality and trust. Because this just is such a hinge thing about whether you're going to be a successful, for me, if it's going to be a successful long-term investment, then I'm basically buy and holding it, right?
Okay.
And the one thing that will shake my faith more quickly than anything else is like management acting in a dodgy way, or that I feel is like dishonest or not optimally caring for shareholders and trying to be in like the, try and get more for themselves, et cetera, et cetera. So I really want to trust that somebody is going to be putting his full heart or her full heart into, trying to steer this company through whatever may come.
Yep.
And so 100%, that is my number one criteria. Like that's exactly why I wrote this wake up call thing, because, I had a lot of other things in my portfolio where management trust was not like 100%. It was like, I think this is probably all right, but like, yeah. And if anything, it's the ones that, it's terrible, because if you don't really trust management that much, then it's like when things do get a bit hard or bad, or there's some bad luck or something like that, you're sure to sell it. Well, for me, when I say you, I'm actually talking about myself here. I'm sure to sell out like right at the worst possible moment if I don't trust management, because eventually I'll lose faith, and I'll lose faith when some bad luck happens or something as well. So then you've got bad luck and the share price is probably down, and management looks like it's not that good, or anyway, it's a terrible thing. So I really don't want to be buying that kind of company when we're going into a period of like uncertainty, et cetera, et cetera. I want to be prioritizing like, oh yeah, at least know you're going to be trying your heart out for me. So that's very key.
Yep.
So I think, look, actually, you know what? If there's any time when I should talk about this company publicly, maybe hopefully like you can hide this eventually afterwards, because I don't really want it to be public info. But dude, the company that is now my largest shareholder is Energy One.
Oh, is it really?
Dude, and the only reason I would give that away, on this chat is because it was a Rask article so many years ago that made me first buy it, like unbelievably. Yeah. Like it literally was. And then the share price is like $1, and you put it in as like a top 3, like whatever rando micro caps that you thought were interesting. And I was like, I already had looked at it for ages before then. And I was like, oh, what? Owen thinks it's interesting too? Well, that makes 2 of us. And then so I bought shares. Because I wasn't sure that I'd like it as much as I end up liking it then. But that was just part of a journey of getting to know it,
Well, for what it's worth, I got Pro Medicus from you, and I still own Pro Medicus today for people that are watching. So, Claude, cheers to that, my friend.
Yeah, man. Like, that's good symbiosis, isn't it? Anyway, hopefully that EOL can be as good as PME. But yeah, I guess I can talk about them because they're like big positions. I'm not really going to be trading them today. Like, anytime soon, I guess.
I'm going to bring up the ticker terminal just for people that are unfamiliar. This is not a brokerage account. This is where you can get stock market data. I tend to rely on this more than my brokerage account data.
Yeah, but the reason I like EOL more than PME isn't that I think that EOL is a better business. It's that it's tiny it's tiny and hardly anyone knows about it. And it's like just got into the ASX All Ords, et cetera, et cetera. Like it's at that earlier part of its journey of discovery. And the reason I brought it up is because this is a great example. Like I trusted management and they got cyber hacked and everything bad happened to them. And in most of the time, if some company got cyber hacked and they made a loss in one half, it's usually profitable, made a loss one half. Like just so many bad things happen to them in a short period of time. I'm talking about EOL.
Yep.
And because I trusted management, I was able to just hold my way through and not like lose my nerve. Whereas like some other company where I don't trust management, you can be sure when that bad luck happens, I'll lose my nerve for sure. And that was, that was when it was like $5 that I could have lost my nerve or something like that. And luckily it came good in the end, well, more recently, but it still could go down to $5 if there's some market crazy thing or whatever. So
one of the things, Claude, that I mentioned on our community this morning was that a lot of people, at least newer investors, even if they're really keen on buying investments, whether it's, they could do ETFs, but if we just focus on shares and companies, a lot of the times what they do is they just go for like statistically cheap stocks, which I think, I'm curious to hear your perspective on this. I think it's absolutely the wrong strategy to do. What you should be doing is using a market sell-off to buy the companies that were often too expensive for you to justify in the first place. Does that make sense to you?
I mean, that's what I'm doing basically. Like the companies that I bought today already this morning, they are not on low PE multiples now. They're just on like more reasonable PE multiples now.
So really good companies that just happen to be sold off, like thrown out in the bathwater.
There's some that are like on reasonably low PE ratios. Like there's one company that I think I already traded today that would be on a PE ratio of around 22 or something maybe. And this is super ballpark, by the way. So there's zero chance you can figure out the company from what I'm saying. But what else did I get that's kind of lowish? Like, I do have a few slightly lowish ones. Like, so I got like low PE stocks in my portfolio. Like, I'll tell you another one that is definitely taking a beating. And definitely, by the way, like, this is not one for like retail shareholder guys. This is just one for like professional people like myself who like know what they're getting themselves into. But it's a good example of the sort of how a microcap can get completely smashed and a low PE stock will just get lower PE, which is CTI Logistics, CLX. Now, I do own this one, not active in the stock right now, even though it looks really cheap, because I know that these cheap stocks can just go down and down and down. It doesn't matter that the PE ratio is like 7 or whatever it is. The dividend yield, mate, on this stock, CTI Logistics, I'll just check it out on the ASX website just because you can't really trust the yield.
This Google Finance thing, never trust this.
Well, it's also because
everyone knows this. Do not trust the data that comes up in Google or your Chat GPT for that example.
Hold on. So their last 2 dividends, which was interim and final, were 5 and 5.5 cents. So 10.5 cents dividend. This thing could cut its dividend to 10 cents and then still be on a yield of whatever, like 6.8%. But the reason that I guess that it falls down is because it's just like a liquidity suck for the whole market, right? For a start. So people are selling one thing to buy another thing, or people are just freaked out. So they're just going out of the market. And then with CTI Logistics, that's a trucking company, right? So I guess what we're starting to see is markets are saying, oh, there's going to be like a recession. We're going to be shipping less goods around Australia. People are going to be buying less, it's that sort of thing. And look, there could be a recession in Australia. I don't necessarily think that it's going to immediately be a recession for us just because of what Trump's doing to America. Do you think? I mean, what's your thoughts on that? Like, how bad could it get overall? Because what the market is basically pricing stocks for is a recession, or they're kind of acting like the E is going to go down essentially.
So it will, I think, no doubt, because effectively what he's doing, if you take, I know you studied law and you've done all those types of things as well. The importance of brinksmanship and negotiation. I actually think that a lot of the tariffs will be unwound in the next month. And he's just using it as I'm going to go crazy and see what people do and then try and negotiate. And people will think I'm crazy and let's see what happens. And so I think that ultimately, Australia, we have a really good trading partnership with the United States anyway. It's actually in their favor. So it's kind of crazy that there'll be so many tariffs there. But I think if you think about what happened, many people watching this will be familiar with what happened in the stock market following the COVID crash. It basically was bang, bang, but then all the issues started like a year later. And so I think that's what you're alluding to, is like the changes that are made today, not necessarily going to directly impact those profits today, but they may in 12, 24, 36 months. And that's when people should be thinking, well, does that mean inflation's going to come back because we're not trading stuff around as much? Is my, whatever I buy from China going to be more expensive? Those are the questions. And I think personally, I don't have a view on the recession, but regardless, what I would say to everyone watching this is whether you're buying individual stocks like small caps like Claude is, or you're buying blue chips, or you're investing in ETFs, know what you own and make sure that you are tilting your portfolio towards companies that would be strong enough to survive any scenario. I think that's kind of the big...
Yeah, that was going to be the next thing, right? So like, first thing is good management, and then the next thing is profitable, good balance sheet. Because nothing is worse than debt in these kind of situations, because debt is like time is not your friend. For a company that has, if it's like got resilient cash flows and cash on the balance sheet, actually, if other people are in distress, that can be a great time for them to make a good purchase. See,
I think we've just lost your call. We lost your audio. But while you're doing that, I'm going to bring up something here, which is I'll give people a bit an example of a larger cap business. Claude's given us some smaller businesses so far, but imagine a business like Costco.
just doing a live broadcast now. So
I think what would ultimately happen is, I'll just mute Claude just for a second. There we go. I think what would ultimately happen to a business like Costco in a downturn is Costco would become more valuable to consumers because people would want to shop there more to get better value when things are on the way down. Take a different company that sells maybe like a discretionary item, like let's say, for example, something maybe like JB Hi-Fi, a wonderful business. Are you more likely to shop for a new TV? Probably not. But are you more likely to go where you can get bulk savings on everyday items? Probably. And the beauty of a business like Costco or Amazon or something like that, it's probably going to be more valuable as a result. So what Claude is saying is effectively what this old investment and CEO mantra, which is never waste a good crisis. A lot of good CEOs and a lot of good companies actually emerge stronger. And one of the key signs, as you said there, Claude, we've got you back, is kind of avoiding companies with lots of debt.
Yeah, exactly. Like that, they're the people that don't have flexibility. If they can't get funding, they just have to take whatever terms they can. Eventually, that usually means some sort of dilution, which usually means that the pain of the low share prices becomes permanent and shareholders lose out. So definitely, actually, if there's anything, I probably even just, it always makes me want to go through and check there's nothing that has too weak a balance sheet. But I don't really invest in those kind of companies very often. Most of the stuff that I'm investing in is profitable, growing, and as much as possible recurring revenue. That is also super key. And then also think about, is it discretionary or is it like core? You know, if you're providing software for radiology scans, then that people are still going to do the scans and use the software and pay you. And if you're doing software for energy wholesale trading, then people are still going to trade the energy, et cetera, right? Unless the lights go out.
Exactly.
The cash flow is still there. The money's still coming in. Yes, the share price might go down, but hopefully if the business is a resilient, high quality business with honest, competent, aligned management, then it becomes an opportunity for it to do well. So that's the theory. But of course, the kind of investing I do is probably only really appropriate for somebody's like satellite kind of thing, and the much more prudent approach is the kind of, it's better to do the kind of more balanced stuff for the majority of your portfolio. The kind of small cap stuff I do is supposed to be money that you wouldn't definitely need in the near term. So it doesn't really matter if it's volatile and goes down during a sell-off or goes down when interest rates go up or whatever the reason is that growth stocks get hit. That does happen from time to time, and you really only get the win from growth stocks over maybe 5-year kind of period or more.
Yeah, that's a really good point you raised there, that a lot of you mentioned at the start of that a lot of it's actually when you invest in really good companies, the share price can still go down even though the company is still growing. So for people that are newer to this, it's really important to understand just because the share price goes down doesn't mean that the underlying business isn't really good. So take that and really remember that. And the final point that Claude said is actually based in literature, which is that it does take years for the profits and all of that sort of stuff to start to play out in the share price, because a lot of us are used to instant feedback these days. You jump on TikTok for a 5-second video. It's not like that when it comes to good investing. It often takes years for the benefit to play out. Mate, maybe I'll ask one more question here, which is that on a scale of say like 1 through to 10, 10 would be like I am ready to go, I'm into this, I'm loving it, and 0 is like I've just sold everything, I'm running for the hills. Where do you kind of sit on that kind of fear versus opportunity spectrum? So 10 equals good, if you will.
Yeah, I guess I feel close to neutral, but that is, for me, like relatively conservative. So usually the way that I feel is that when things are going smoothly, the way I feel is that there's good money to be made investing in good quality growth stocks, and usually the returns are pretty good, and sometimes you have a really good year, as we sort of had in the last year, and then often you like have a tough year after that. And that makes, at the beginning of it, I feel sort of bearish, like at the beginning of when things start to turn. And now I'm starting to feel a little bit more like at some point they'll probably try and stop the stock market cratering, right? Like I guess it could go down forever, but also, a lot of these problems are being caused by the fact that they're putting these tariffs on that make no sense. The percentages they're charging people isn't even like relevant to how much they get charged by the people. It's like really weird. They keep on saying stuff like, "Hey, we're going to bring back like shoe and clothes manufacturing to the USA." It's like, dude, no, you're not, because like they don't want to work for $2 a day there. So,
yeah,
and they can make the stock market go up by just taking this away, right? So it's also within their power to fix the problem. So at some point, if they start fixing the problem that they created, stock markets should go up. Now, my basic tenet is that they want it to go up at some point. But I guess in a really dark situation, you could say, well, actually, what they want to do is cause a depression to be able to radicalize people further, to be able to dole out benefits to like who they consider like their base or their supporters, and they just want things to be super dark and people suffer. And that could be true for a while, but I just don't see how, like, Trump's come out and said multiple times now that he wants the third terms. And if he can't get it himself, then the alternative is to, do a Medvedev or whatever his name is, like where you just have like another prime minister come in or whatever.
Yeah.
Or your son or something like that. So he said he wants that. And, I don't see how it helps his plan to have like all of the rich people be like, my portfolio, like I don't like this anymore. Do you know what I mean? Like at some point, if you piss off the people with money enough, surely they're like, there's some pushback, because I guess in a situation where you have a small group of people who make all the money, like if it's more like, or you get the government contracts because you're like friends with Donald Trump, then the winner circle is quite small, right? Yeah. So yes, there's going to be a few billionaires that do great out of this, maybe Peter Thiel, Musk or whatever. They'll be insulated by government contracts or however it is that they come good. But there's like a whole, there are a lot of billionaires, and a lot of those billionaires are surely a juicy target for Musk or whoever it is that's getting the new, that government contract that Musk is now going to get exists with someone else previously. So surely if it just keeps on getting haywire, then it doesn't really serve Trump's goal, which is to increase his power or prolong it or whatever. So I would have thought, this is a theory, could be totally wrong, at a certain point, they're taking the pain now, and at a certain point they want to stabilize things and then have a sort of bull market going into the end of his presidential term. So that still could be a lot of more pain now. Or it could also be that they kind of care about the midterms and that they wouldn't want the market going up in the midterms. And if that's the case, then we might see an end to the like really insane policy a little bit sooner. But overall, it's actually really just hard to predict what is going to happen in the US. Like certainly, I couldn't have imagined this. Like I got myself into, one of the mistakes I've made, which I can talk about, is that I did sell most of my US stock portfolio like a month ago or over the last few weeks or whatever, but I kept my Google shares. And it's because, I guess years ago when my son was born, I kind of made a promise to myself that I would like buy him what was then a Google share each year, and now it's a bit more because they split, but buy him a Google share each year and keep them for him and like give them to him at, when it was 18 or whatever. And now like basically like I had accumulated Google shares and I sold all like my other shares, but I still have the Google shares because I couldn't bring myself to sort of break that promise to myself in the past. But now I've just like watched them go down like really quite a lot. So
but that whole strategy overall of buying your son a Google share, keep in mind,
he's not that old. He's not that old.
Even over the last few years, though, for people that aren't familiar, Google/Alphabet has split its stock. So it used to be what, like $3,000 or $2,000?
No, it used to be like 1,000 a share. 1, I think is it 1 for 10 that they split it? I think it was.
I think that something like that. Yeah. So
I hope it was 1 for 10.
So
that's what I thought it was.
So in effect, I think you've still done a good job. It's basically an index fund on the internet. So it's no,
it was 20 for 1. It was 20 for 1.
20 for 1, right? Okay, there you go. So yeah, $2,000, say, let's say.
Yeah.
So effectively, you've still done a good thing for your son by holding these shares anyway. So kudos to you, mate. Maybe then one final thing, which is just a quick one, and then I'll let you go, mate. Which is, if people want to say get like this thing, like your write up you did recently, I'll put a link into everywhere right now. But where can people go to learn more about you and to stay abreast of all the things that you're doing?
Oh, well, I reckon the best, obviously the website, A Rich Life, but that part of that is like paywalled. So the best way to join the conversation, I reckon right now is, mate, I started a new podcast, the ASX Small Cap Wrap.
I'll put that in. ASX Small Cap Wrap.
Yeah, and it'd actually be great to have you on the podcast at some point when you have time, because we're only 2 episodes in.
I'd love that.
And because we stopped doing Baby Giants a little while ago, and so I guess like this is the stock chat replacement for that, in terms of my time. So like I don't know, I need to make like a web page for it or something like that. But at the moment, you can still find it just by searching for ASX Small Cap Wrap there. Even that top link was right. It was just that's someone else's website, but they linked to it there, so that was great.
Okay, yeah, I'll bring that up.
That one's right. That's the correct link.
Yeah, okay. Great.
Like that's it, but
it's you and Patrick. Okay.
Yeah, exactly.
Okay, I'll pop that in the chat right now for anyone.
Yeah, no. Can you pop the YouTube in actually, because that's the number one thing that I really want to do it on.
Yeah,
that's the main thing. Yeah, sweet.
Cool.
Cool. Awesome. Well, thank you so much for having me, and
thank you for
I really
joining
appreciate it. And I love the idea of just doing the live show when you have like a red day like today.
Yeah, it's this is the time when we earn our keep. You and I as professionals helping people invest better. So
yeah, you get up early on this day.
Yeah, exactly. So, mate, this is awesome. So for anyone that obviously everyone wants to learn more about Claude and A Rich Life and the podcast there, it's all in the live chat there. So just click on that. Claude, absolutely love your work. Thanks for joining us, mate.
Thanks heaps for having me. And everyone, we don't know what's going to happen. No one does, but just stay calm. Don't freak out.
Yeah, great. Love it, mate. Thanks.
Cool. See ya.
Cheers. That is Claude Walker, obviously a wealth of knowledge. Absolutely delighted to have him join us. And Claude, for what it's worth, was just reading the Rask email this morning and thought, oh, those guys, Owen's going to go live. I'll do the same. And we just jumped on together. Now, I do realize that there's a lot of questions here, more around like the personal finance, financial planning, portfolio construction stuff. So we talked a lot about stocks. I'm happy to answer some questions now about anything. We'll go for about another 10 or 15 minutes. This is all available for replay. If you're on your work break and you have to go back to work or something like that, you can come back and watch it. But I'm happy to answer questions. I noticed that fellow Owen Boxall, at the very top of the show today, did ask a question I wanted to come back to. Could you explain using a hedged or unhedged gold ETF, maybe using a 50-50 strategy? So what I'll do with this question is a lot of people are interested in gold right now because, as Claude said, you probably wanted to hold gold a little while ago and then sell now, but let's just talk about that for a moment. So I'll just put that comment down there and I'll bring up my screen quickly so everyone can see this here. If we go back to the 50-50 portfolio, this image, and I'll just get all this junk out of the way. 1 second. So if we just get rid of all of that and then bring this guy back in, I'll bring it to the front even. So imagine you've got a 50-50 portfolio. What a lot of people are thinking about right now is, do I add gold to my portfolio to try and protect it on the way down? You'll notice here that we do not at Rask have gold in our portfolio. On the defensive side, which is this bit that I'm about to highlight here, is this side, right? So this here is the defensive side of a portfolio. Now, what you can see is that we've got global bonds. So I'll just put a B next to anything that's a bond, right? And then we've got Aussie bonds over here, and this is just cash. So AAA from Beta shares is just cash. iShares, Australian bonds, global bonds with Vanguard. So you can see here that these are kind of defensive positions, right? So what would happen typically in a market crash is that everything on this side of the fence would fall, typically, and everything on this side of the fence would maybe not even go up, maybe just stay flat-ish. So what we can do is we could probably just look at these just using Google, which is obviously not that great, but we'll just have a quick look over the last month. So this bond ETF has gone up. This bond ETF has gone up. And then let's go VAS, Vanguard. This has gone down. IVV, which is the S&P 500. This has gone down. So people are wondering, a month ago, people were saying to me, Owen, it's kind of stupid. Why would I buy a bond ETF? I don't really like that you invest in bonds. Well, now they're not saying that, because obviously the reason that you hold bonds is so that at a time when markets do correct like they are now, you've got this side of your portfolio that's holding up really well. This is just cash. So this would obviously go up. This is a disclosure. BetaShares is actually an advertising partner on our podcast, but you can see like that's flat. It's also paid income over the past month, hence the drop there. And so that's what this part of the portfolio is for. Now, if you use gold, right, here's the point about gold, and this is where it relates to what Owen was asking about. If you use gold, some people consider it as this part of the portfolio. So this would be the defensive side of a portfolio, right? A little slither of gold, they say, can go in there. But some people consider it as what we call a growth alternative as well. So some people consider gold as a growth investment, because gold, depending on things that are unrelated to the stock market and the bond market, can go up or down. So let's have a look at gold in US dollars. Let's just use the most popular. Let's just go with the GXLD from GlobalX. GlobalX is also an advertising partner on our website. So gold's up 9%. Let's go in currency hedge terms, 3.9%. So you can see here that gold's done pretty well. So having a little bit of gold during this massive uncertainty would have been a positive. Bonds were also positive and with some income, but not as much. So adding gold in here on either side could be a worthwhile strategy. How much do people typically own? It's not much. It's like 5%. Statistically, you can have a bit more than that, but most people have somewhere in the realm of 5% or less in a diversified portfolio. Now, back to the crux of Owen's question, before I get carried away here, I'm just going to go right back up to my side of the screen. Could you explain, using a hedged or unhedged? So the difference between whether you use hedged or unhedged is when you buy gold. So there's the most popular unhedged, meaning that it moves with the currency, is it's the GOLD ETF, but it's actually, they've since replaced it with a new ETF from GlobalX called GXLD. What effectively this does is you get the gold price, which say it's like $3,000, but you get that in US dollars. So when you convert it to Australian dollars, you actually benefit if the Australian dollar falls. So even if the gold price stays flat, just because you're investing in US dollar gold, you benefit. Now, if you go with the other version, which is the currency hedged version, effectively you don't get any benefit or negative from the Australian to US dollar. So effectively, you can have gold with currency hedging or gold without. What I'm currently considering for our portfolios is gold hedged. So gold with no currency impact, meaning that the currency impact is hedged out. And the reason for that, I'm sorry if this is a bit technical for some people, but I'll pull my head above water in just a moment. The reason why I'm considering currency hedged gold is because the Australian dollar has been falling. And one of the reasons most recently that the Australian dollar has kept falling is that people go to the United States currency, the US dollar, when the market gets uncertain. And the reason that they do that is because the US dollar is seen as safer than any other currency in the world. Now, all the Bitcoin enthusiasts out there are like, oh, this is my chance to say something in the chat. Well, crucially, the US dollar tends to strengthen, meaning the Australian dollar falls during moments of uncertainty. So we could see that in the global financial crisis. If you see this here where my mouse is, it actually says 2008, and it went from, what was it there, 91 cents into 2009 to 70 cents in like a year, right? And then as we emerged from that global financial crisis, everyone was like, oh, actually, Australia's not that bad. We may as well just go and invest there. Oh, look at Australia. They actually recovered better than we did. And so you can see that there, that's why it peaked. The Australian dollar went back up to, I think it was nearly $1.10 at the time. $1.03 it says on this chart. But over time, the Australian dollar has weakened against the US again. And the long-term average is around about 70 cents, depending on where you look at it. So I'm thinking if it's for a very small position in our portfolio, like a very small, like if I'm saying like that's how much we're having a gold ETF at Rask, if we've got that much in our portfolio, it's not going to have that big of an impact. But the reason that I would put it on this side of the line and not this side is because I don't see gold as a growth investment. I just see it as a defensive investment. So I would have it on this side. And the reason that I would do currency hedged is because the reason I'm investing in gold is not necessarily for the growth of it, it's just for the stability of it. So it's a kind of like a different inflection. Colin, you've asked a good question. So I'm going to release an email for anyone that's on the Rask mailing list. Free sign up. You can go here and get a free Rask account. I'll pop that in the chat now. Here we go, that one. I'm going to share with our investors why we're making changes to our portfolios, or will we be making changes. One of the things that I'm going to do this afternoon and this evening is actually review all of our portfolios so that then everyone can rest assured knowing that their portfolio is taken care of by us. But I'll share that in our mailing list as a newsletter anyway, once I've had a chance to chat with the team about it. There's another question here from Colin. Will Australia look to start cutting rates to keep the dollar suppressed? That's quite a technical question, Colin. What I can tell you right now is that effectively with the currency movements, for anyone that's new to this, is when you have one country with higher interest rates, it's not perfect, but one country with higher interest rates, typically money flows to that country because people that have a lot of money, like big super funds like Australian Super, massive global banks, big investors throughout the world, is they'll go, oh, well, I could just put my money in the United States and I'd get more interest. Why wouldn't I just do that? And so they put their money there. And what that means is that then that makes that country's currency stronger. So if, for example, people thought the United States was going to raise interest rates over the next 2 years, money would flow to it that way so that people can invest there. But crucially, what that actually does is it makes that currency stronger against the one where the money's left. So if money was leaving Australia to go to the United States, the Australian dollar would go down. I hope that makes sense to people. But what does it actually mean, like in reality? Like, what should you actually do about it? I don't think you need to do that much. We only have a small part of our portfolio that's currency hedged. The rest of it's kind of free floats. The key thing is that for people to remember that even though the stock market can rise and fall, there's a pro and a con of currency. So let me give you an example. Most of us here would probably know of this ETF. This ETF is the S&P 500. So this is the United States stock market, right? But it's an Australian ETF. So when you buy it in your brokerage account, carry trade. Yeah, that's a good one. Yen, carry trade, Graham. So when you buy the United States stock market from your Australian brokerage account, you're buying from Australia a US investment, right? So some people ask me like, well, why is this down 4% today? And the actual stock market in the United States is down 6%. Now, this is not obviously a perfect comparison, but the reason is that the currency can actually insulate you. Because you're investing in the United States, the currency, you've actually benefited from the currency falling, even though it's only one day. So that's how you can kind of make up that difference. Chris, you asked a good question. Good to see you, Chris. You don't seem to have any European exposure in that portfolio. Thoughts on ETFs like ESTX, given the current issues in the US? It's when we set up our portfolios, Chris. So when we set up, a lot of our investors questioned us on two things. One was gold. The other one was why no Europe? To be honest, I'm quite a fan of American exceptionalism in terms of business. I think that if you look at all of the great companies in the world today, a lot of them are from the United States. My little one out there has got infant formula that's from Nestle, but I can't really think of anything else in our house that comes from Europe. I've got an Apple computer sitting on that over there. I've got an Apple computer that I'm recording to here. I've got an Apple iPhone. A lot of you would use Microsoft devices. So I think I use OpenAI for AI-related things. What other apps do I have here on my computer? I've got a lot of technology companies from the United States. And so my point is that a lot of the long-term growth that we've seen over the past 30 years has come from the United States, from the kind of the capitalistic focus, the only get 2 weeks of holiday each year, the focus on entrepreneurialism. Like if you look in American culture, entrepreneurs are seen as like amazing. They're kind of pinned up in society as, the pinnacle, most successful, quote unquote. I don't necessarily believe in that, but like quote unquote, the most successful, right? Whereas if you look at the Australian culture, very much it's this tall poppy syndrome. So we just shoot down the person that is the wealthy one or the one that runs a big business. We just shoot them down. That's our culture. And then if you look in Europe, it's very much the same. Probably like you just look at the famous football teams and you'd probably think that they're the ones that are pinned up everywhere. And I think that ultimately that cultural difference has a significant distribution, has played out in a significant distribution in the way the world has formed in terms of successful companies. And so over the long term, I think that the United States is a much more fruitful place to invest. You could say the same for China, except they don't have the same property rights. So that's why we are heavily skewed to the United States, because we're investing for 10, 20, 30 years into the future, right? So that's why we are more skewed there. Crucially, and this is an insight that a lot of people miss, is like if we go back to our portfolio, or just one of them, I'll just pick, say this one, the Jupiter one, which is the highest growth. So if we go back to the portfolio, Chris, and I know you know this, Chris, because you're in the game, you get it. But if you look at the portfolio, so most people break it down like they've got their share portfolio, their ETFs, and they're like, well, I've got this much in international shares, this much in Australia, bonds, and some cash, right? Then if you go down and you say, oh, okay, cool. So I've got this ETF for Australia, this ETF for the United States. Cool, okay. But what people really fundamentally miss when they just look at something so simply like this is they go, oh, there's a lot of US stuff here. Why so much US? But what if I told you that amongst all of the companies that are listed on the United States Stock Exchange, approximately 30% of their business is done outside the United States? So the way I think about it, I'll bring up another chart here. So this is a really crucial piece of understanding. I'll get rid of this frame actually. So if you or me, we're just humble little investors here, we go down to the building called ASX. So this is the ASX, and we go and buy our ETFs. So we've got our ETFs, which look like a pie chart, right? There's this many stocks, there's that many stocks, whatever. So we go down to the ASX and we buy this ETF. And it says on it, USA on the tin of this brokerage, of this ETF. What actually is happening is that money is then invested in, I'm going to try and draw the United States. Here we go. And I think there's Hawaii and Alaska, right? So what we think is the money goes ASX, USA, and then we get the companies from the United States, right? Companies, right? What is actually happening is those companies in the United States, depending on which ETF you invest in, actually generate 30% of their sales from around the world. So even though it says that you're only investing in USA because you have the S&P 500 or right? Be really mindful that you're not just getting the USA, you're actually getting companies like Microsoft, Apple, Amazon, Google, Alibaba is in there. All of these companies, they might be on the United States Stock Exchange, but you're actually getting them globally exposed through that one investment. And so the question is, well, why would you do that? Why don't you just go with like, what's the other one? I've got baby brain at the moment, not VTS, VGS. So why not just go with the Vanguard Global Shares, which is a great ETF. I think it's really good. I actually think you don't need to use that because this one is already globally diversified. And the difference is that this ETF, the IVV ETF that we hold, I should say IVV right here, the IVV ETF, what the actual difference is that you don't have to worry about things like intellectual property rights or weird things happening in other parts of the world. It's just invested in America via BlackRock, which is the biggest investment company in the world. And so you get intellectual property rights, you get global diversification, you get a single trade, and you get 500 really good companies at a really low fee. So that's how I think about it. Now, I know I went on a bit of a tangent, but I'd encourage people to think like carefully about where they put their money. Secondly, I could be wrong, and we might add an ETF. Like, I don't know about ESTX. I don't know much about that, but I have looked at the past at VE. I think it's VEU. No, that's not it. What's the IEU from BlackRock? IEU. So we've looked at this ETF quite a few times. So this ETF is from BlackRock. I think it's a really solid ETF. We don't have it in our portfolio. We just don't. We would have it at a very small position, but right now we just don't. Now, I realize that Colin and Graham get the prize for excellent questions. Love it, reading my mind. Yeah, okay, that's great to know, Claire. Thank you for that endorsement for them. So, Colin, is there a tool available to see the effects of currency changes? I'll put this up on screen for everyone that may be watching, not on YouTube. Is there a tool available to see the effects of currency changes against shares at current rates, showing 60% change to 70% change? I don't know of one that specifically does that, Colin. I'm just trying to think off the top of my head. If you're looking for this, so this is what we would call sensitivity analysis, Colin. So the sensitivity of your portfolio or your investment or something to a change in something else. One of the I guess one of the reasons for this is that why it might be hard is because not all ETFs trade at exactly the same time. So take for example, I'll keep using this IVV ETF, right, as an example, because you're all familiar with it. It's US shares. This is down 4% today, right? But how does it know to be down 4% when the United States is asleep on a Sunday? Right. This is a United States share market ETF, but how does it know? Right. When we know that the S&P 500 fell 6% on Friday, their Friday, and could go up or down tomorrow. And so even though like short-term changes may not actually be fully reflected, but if you wanted to zoom out, one of the really simple things you could do, Colin, or anyone could do, is when you go through a portfolio. This is just obviously general information only on the show. You could go through the portfolio and be like, well, this one here is exposed to the US dollar. And that's really, this one is also a little bit exposed. Oh, not really, it's currency hedged. So this one might be in a little bit of a way currency exposed, but all the rest of them in this Terra portfolio aren't. So you could be like, well, if the currency changed X%, what would happen? The problem is when people have a lot of shares in their portfolio. So say you've got like 50 shares, which it's wild. Say you've got 20 shares, right? One of the things that happens is it's really hard to keep up with that amount of shares to begin with. But the other thing to keep in mind is that not all of the companies would react in the same way. I'll give you a really good example of this. Now, I'm going to bring up a company you all know really well, which is BHP. All right, so BHP is down 5%. It was down pretty harshly before, it's down more. If you're going company by company, what you can do is if you go into any company's annual report, this is going to be a massive document, by the way, just so you know. Companies, through their finance teams, are actually required to do something called sensitivity analysis. And this will actually give you an indication of, so they're saying different scenarios, 1.5 degrees. So a 0.5% increase in the discount rate. So you can start to see like these things are all in the notes to the financial statements. But one of the things that might happen for Australian investors is, okay, let's use this example again. So say instead of an ETF in this instance, we've got BHP. So it wouldn't be like that. Let's just get rid of all this stuff here. So if you or me, happy little investor, go down to the ASX and we go and buy BHP shares. Now, BHP is on the Australian Stock Exchange, but what it actually does is it digs up, this is Australia, look at that's great, don't forget Tassie. So this is Australia. What BHP does is it takes a bunch of stuff out of the ground in places like this, and then it ships it to China. I don't know, I'm just going to do a big C for China. So that's China up here, right? And then it brings the money back, normally via Singapore or some other place where the tax is more effective. Sorry, BHP, you've been exposed. So basically, that's what happens, right? But in this scenario, when BHP sells its iron ore, IO, it actually, that's an I, sorry. When BHP sells its products, it's actually selling them in US dollars, right? But when you see the annual report from BHP, I wouldn't say beta shares, right? Annual, we'll do an AR. That's actually in, actually, I don't know if they present, I'll just, for the purposes of this, I'm actually just going to make sure of this in a sec, but they may actually report their profits in Australian dollars. So even though you're an Australian investor investing in an Australian company, which has Australian operations, it may actually be benefiting from currency movements. So you can see now, Colin, why it gets really complicated to try and actually accurately predict how much currency you're exposed to. So I hope that makes sense. But broadly, for most people in ETF portfolios, it's just about knowing which ETFs are currency hedging and not. For us, reports in US dollars, thanks for that, Graham, but it's a share price is in Australian dollars. And so most of us, when we, sorry, not that one, this one, when we invest in things like bonds, we go with a currency hedged global bond ETF. That's what we've done here. So that's almost always, it always is currency hedged, where shares can go hedged or unhedged. Sorry, I keep going too far in the detail. Yeah, Graham's had some good answers in here. If prices increase, Michael, good question. Even if you're exposed 30% in US, if prices increase under the tariffs, won't the ETFs be exposed? So no matter what happens under the tariffs, really anything will be exposed. That's the way I'm interpreting it. I don't know exactly what the US government has in store, but when Australians invest in the United States, even though there's a tax treaty between Australia and the US, we pay up to 30% withholding tax. Like any investor listening to this would effectively pay 30% withholding tax. And the only way to reduce that is to fill out the W8 Ben form, if you've seen that through your brokerage account or your SMSF, and that effectively reduces it to 15%. Like, will that change? I don't know. There's going to be, like, we don't know exactly what's going to happen with these tariffs. But if you have a lot of Australian shares and you have a lot of exposure to, local good companies and good ETFs, I think most of the time, you're going to be insulated from that anyway. So won't even need to worry about all those things. M77, if Labor get back in, it will tank even more. Well, I don't know about that. Maybe. So yeah, Chris, you brought up something before, which was IHBV to protect against currency. One of the questions that people really struggle with is how much do I do in this ETF or that ETF? That's like where good financial planning comes in and all those types of things. But for us, we do have a bit of currency hedging in here. Maybe I'll finish with this question. Colin, you found a tool. Feel free to share that with us in the chat. So there was a question here from Jonty. Where was it? I'll stop sharing my screen for a sec. Hey, Owen, why AAA over another ETF like Harvest? So that's a good question, Jonty. Actually, I'll bring my screen up again right here. So for people that don't know, we have a bit of cash in our portfolios. So this ETF here, Jonty, the one that you've referred to, now I'm not giving, to get rid of that, I'm not giving personal advice here, but the reason that we don't use an ETF like this in our allocation, where is it? Where did I just have Canva open? I don't even know. I think I've just lost it. So the reason that we don't use an ETF like this is because this is not actually a cash ETF. This is not comparable to AAA. This ETF here is actually a share-based ETF. So this invests in shares. People use it for income, but it's shares. And so the key difference here is that we wouldn't have this in the defensive side of our portfolio. It would only ever be in the growth side of a portfolio, because effectively you're still investing in shares even though it pays income. So one of the reasons, and I'll bring this back up here now, I've got it. So one of the reasons that we hold cash in our portfolios is because cash is easy for people to understand. It's really liquid. So that's for people that don't know that. I'm talking about this part right here. It's easy for people to understand. And the good thing is that at a time like now, if you have cash in the bank, as Claude was saying earlier on, if you have cash in the bank, you can use that cash to go and buy things when they're cheaper. So that's what I'm going to be looking at for the rest of today. Hopefully that makes sense. Okay, so yeah, just curious. Jonty, that's why. So there's a lot of good cash ETFs in Australia. There's the Bill one, a BILL. There's another one from iShares, I think. There's a few different cash ETFs out there, but one of the big things is, and this is a retirement portfolio that we're looking at right here, one of the big things is that just making sure that people are comfortable with the level of risk that they're taking. If we come back here to this final thing, is like maintaining a strong cash balance inside your brokerage account if you're an investor like me in there, or if you have, if you're watching this and you're on the edge of retirement, you should absolutely opt to have more cash than less cash. I got a wonderful question from Shane in the Rask community this morning about, he made a comment about how if you're retiring right now, it would be a very, very scary time. And I said to him, well, actually, normally when you go into retirement, you get financial advice and they say, Mr. and Mrs. Smith, make sure you have 1 to 3 years of income available to you. If you can, of course, some people don't have that, but if you can. And let me explain to you why. In traditional financial planning type scenarios, you can use a 3-bucket strategy, right? It's not drawn to scale, but you'll get the idea. So if you use a 3-bucket strategy in retirement, this is what it looks like. So this would be like short term, this would be medium term, and this would be long term. So I'll make it clearer so you don't have to worry about my Mr. Squiggle. I'll pop this here and I'll use actual letters and words. It's probably too big. So in the short term bucket, you have savings accounts, you have offset accounts, and you might have some term deposits, like short-term term deposits, like under a year type, under 1 year, like that, right? So those are the things that sit here in the first bucket, and they effectively, for people watching at home, and you can do this if you don't have to be a retiree to use this strategy. Effectively, this money that comes out of here is the money that you use to live your life, right? And so you should never be worried about a market crash if you've got an adequate amount of money in here. And a lot of people would say, well, you want maybe at retirement 2 years worth in this bucket, right? But now if we move across to the next bucket, this might be things like, I don't know, a share portfolio. So this might be like a share outside of super, or like an ETF portfolio. It might be like if people invest in like longer term deposits, so medium term deposits, something like this. Deposit, there we go, English. Oh, no, it's not. There we go. And so this might be like a 3-year term deposit right now. It might be like even a rental property may be in here. I'm cautious about saying that, but it may be in here, right? So that's kind of the components here. And then finally, we have super. So superannuation. We have maybe other rental properties. So these should probably, the rental property should probably just be in here. People might have like family trusts or a business or things like this, right? And the key thing is, guys, is that if you think about your money like this, one of the things that can happen is as you go from left to right, you can afford to take more risk because you know, well, I'm treating this thing over here as a separate portfolio, this thing over here is a separate portfolio, and this thing over here is not a portfolio, it's just cash. Because if this bucket here is appropriate for you, then you feel calmer investing this and this when times get uncertain. So it's not all or nothing. And one of the reason that this works really well is because inside super, which is a tax effective thing, as this grows, because you're contributing to it or because it's reinvesting, eventually it gets to a point where it's at the top and then it tips over into this one, right? And for people that are in pension mode, you know what I'm talking about. So this is also growing. So this is reinvesting in itself. But over time, this one grows up as well. And this one pays income and franking credits and all that sort of stuff. And then that one tips into this bucket, right? And then obviously this one is paying for your European holiday, or you're catching up with the grandkids or doing whatever you want to do. But that's how the 3-bucket strategy works. Daniel, you say, get this man an iPad and a pencil. Yeah, I do need one. So you can see that this is broadly what a 3-bucket strategy is. And so if you set up your money like this, you know, this is like your budget, you can automate all of that. You can automate a lot of this stuff. At retirement, if you've got like a nice big bucket here, these other ones, you can afford to still be a bit more focused on growth. It's a big mistake that retirees make, is because they haven't thought of this strategy. They actually think that once they hit retirement, it's like, all right, no more risk, maximum amount of conservative investments, not realizing that even if they retire at 65, they're probably going to live to 90, which is still, you do the math, a long time. So I keep that in the back of mind. Okay. So, alrighty. So that's basically it for today, ladies and gents. I do really appreciate your time. So, yeah, Jeremy, IVV is just the Australian version of the United States stock market. All the IVV ETF does in Australia is take people's money when they buy it in their brokerage account and then puts it in the US version of the same ETF. That's literally all it does, which is why it's low cost and all those things. It's got a little tax benefit on the way through, but that's literally all it does. So this recording is available for playback. If you, I know it's 90 minutes long, but if you think someone would benefit from seeing this today, share it with them. You can find us on the Rask websites. I'm going to spend the rest of my day. I've cancelled all my client meetings, but if you want to jump into the chat in the Rask community, you can do that. I will be hovering through this chat here. We're getting some great commentary here from the community today. So you can see like absolutely wonderful commentary from everyone in the Rask community. Obviously, everyone is extremely well informed now. So thank you for taking the time out today. Stay calm, as Claude said. I really appreciate Claude coming down. Remember that this too shall pass. Keep your plan in the back of your mind. When you have either a financial plan from a financial advisor or you've actually just written down why you want to own things, you'll be so much more comfortable because it won't be like the uncertainty as the market's crashing. You'll have a plan for things. So I'll also be probably, depending on how volatile this week is, I'll also be emailing our database this week with updates on what to do and when. My job for the rest of today, as my shirt's a bit unbuttoned down here, is to go through our clients' portfolios and to make sure that if we need to rebalance, we do that. But we're going to be here. You can use the instant chat support on our website too if you're a bit unsure of yourself and what to do. So, yeah. LD, a few years ago, a wise man told me to buy VDHG each month and I would be okay long term. Does he still recommend this? I've always said that VDHG is a great diversified ETF and it's great for people starting out. There are some reasons why some people wouldn't want to use it and some people would want to build their own ETF portfolio. Obviously, I can't give personal advice here today. If you do want financial advice, just head to the Rask websites, by the way. I'm actually not panicking, to reiterate what Claude was saying as well, is I actually made a commitment last week to invest $100,000, which is a lump sum. It's not like I have $100,000 just lying around. I made a commitment to invest $100,000 last week, and a big part of that's going to that Terra portfolio, which you saw before. But I'm also actually looking at buying some individual shares. You know, even if it's just $500 here or there, I'm going to buy a bunch of these shares while they're on sale, and they might fall, but that's okay. I want to make sure that you understand that that's just me. It's not what you should do. You should get financial planning advice if you're unsure of yourself. But yeah, we can see that the market's already come back a little bit in the time that we've been talking. Don't know if that's going to continue. In the short term, stocks are risky. In the long term, stocks are risky not to own, as Warren Buffett once said. So jump into the Rask community if you have any other questions. Don't forget that any of the information that you heard today or watched was strictly general in nature. I don't know your needs, goals, or objectives, so be sure to speak to a financial planner before you act on any of the information that you may have heard today. Getting financial advice is really important, particularly as your portfolio gets bigger. Is it worth the cost? Well, if you have to ask that question in this market, it probably is. It might cost you a little bit of money, but just get it if you need it, especially in retirement. I think everyone does. So our head of financial advice, get this, our head of financial advice at Rask, she won't mind me saying this, has her own financial advisor. How's that? That's how much she values it. So if it's good enough for her, it's good enough for the rest of us. Thank you, everyone. Don't forget, jump in the chat, check out A Rich Life for Claude, and have a wonderful day. Stay calm. Everything will be okay. Bye for now.